This chapter looks at the statement of cash flows and how you construct it and interpret the statement. We will concentrate our efforts on the indirect method. Therefore, we'll look at 5 learning objectives and exclude learning objective 6, which is looking at the direct method for reporting cash flows for operating activities. We also won't spend any time on the spreadsheet method for the indirect method, so one of the supplements will also be eliminated from this presentation. As we consider the statement of cash flows, it'll be helpful to think of the other 3 financial statements, and also that those financial statements are prepared on the accrual method. And this is where understanding what the accrual method is all about becomes critical, because as you know, when we accrue, for example, a sale that we haven't yet collected the cash for, we're still reporting that sale and it shows up in our net income, even though we haven't collected the cash. That's one example of the difference between an accrual and a cash transaction. So anyway, the statement of cash flows tells us essentially how we are generating and then using our cash within the business. So it's the link between the accrual basis financial statements, balance sheet, income statement, statement of retained earnings. It's the link between those accrual-based financial statements and the cash, how we generate cash, how we use cash. Cash is the lifeblood of a company. It's very important for us to understand how we are generating and using our cash. The statement of cash flows looks at business activities and the related cash flows from those activities from 3 perspectives: operations, investing, and financing. And operations, of course, becomes the most important perspective, in my opinion, because we ought to be generating the majority of our cash from a business, from operations. That's what we're in business to do. So anyway, so those are the 3 perspectives. Operations are our day-to-day activities with with our customers, our suppliers, and our employees. Investing is when we buy assets to use in our business and when we dispose of those assets. So don't think of investing as having to be from stocks and bonds of other companies and that kind of thing. Investing means mostly when we invest in our own business and our operations. And financing is when we take out loans or issue stock and that kind of stuff, or when we repay those loans or retire the stock, et cetera, et cetera. So in the statement of cash flows, operating activities, when we talk about cash, what we're referring to is of course the actual currency that we get through transactions and checking and savings account and any other very highly liquid short-term investments, and we use within 3 months of maturity as the cutoff measure to understand whether they are highly liquid or not. So let's take a look at this condensed cash flow statement from Under Armour and get a feel for really what the really basic statement would look like. So the first line, net cash provided or used by operating activities, and you can see that is the biggest number there. Next line is the used by investing activities. So apparently they invested in some assets for the company during the year. And then finally, provided or used by financing activities. And you can see that they either took out additional loans or issued stock or something to generate cash for financing activities. And then we come down to the net change in cash for the year. And then look at those last 2 lines. Cash and cash equivalents beginning of the year was 40. You add the net change in cash and cash equivalents end of the year, then 102. That should tie to your ending cash balance. That's so what we're really doing with the statement of cash flows is we are explaining the difference in cash on our balance sheet from the beginning of the year, i.e. the end of last year, to the end of this year. And the statement of cash flows explains that difference for us. So for for operating activities, we're going to look at the three perspectives here. Operating activities are the cash inflows and outflows that relate to revenues and expenses on the income statement. The inflows would be the cash provided by collecting from customers. So if we sell to customers on a cash basis, that counts. If we collect from customers that have charged on accounts or are collecting our receivables, that counts. If we receive dividends on other types of investments we have made, or interest or that kind of thing. Outflows, you can see those are the normal cash outflows when we, if we use cash to purchase services, pay wages, and pay our payables, that type of thing. That's what we're talking about. As I mentioned, we're going to look at the indirect method. This is a comparison between two methods for reporting operating cash flows on a statement of cash flows. There's the direct method and the indirect method. We are going to look at the indirect method. That's the method that takes our accrual basis net income and adjusts for the difference in the accrual items in that net income to come down to a net cash provided by operating activities. So that's the method we're going to focus on here, but it's good for you to know that there are two methods, and this is what the two methods look like. And for investing activities, these are examples of inflows and outflows. And remember, when we say investing activities in the statement of cash flow, we mean whether we are purchasing property, plant, and equipment for our use, or it could be that we are purchasing investments in securities to earn a return on those as well. But we include the purchase of property, plant, and equipment, and that is more usual when we talk about investing activities. The cash provided by investing activities could be if we sell or dispose of property, plant, and equipment that we already own, or of course if we sell investments in those securities, or if some securities mature and convert to cash. And so we'll take a look at Under Armour's investing activities, and they invested in equipment or purchased equipment, and also purchased other assets, either intangibles or other assets. And that third category that we'll see on the statement of cash flows is financing activities, and that's when we borrow from lenders or other debt types of contracts, issue stock to owners. So other debt could be issuing bonds, those types of things. Outflows is when we repay those liabilities, repurchase stock from owners. Those are the treasury stock transactions. And remember, if we pay cash dividends to owners, that will fall under the financing activities in a statement of cash flow. Remember, dividends never go on the income statement. They are not an expense. They're a return of cash to our shareholders. And so if we do return cash to shareholders in the form of cash dividends, that would show up as an outflow under financing activities, because the issuance of stock is also a financing activity in the statement of cash flows. This chart just shows us the relationship between the cash flow categories on the statement of cash flows and the classified balance sheet categories. So when we talk about cash flows from operations, what we're really looking at is current assets and current liabilities. That's the relationship. In other words, it's whether we're collecting our receivables, cash, that type of thing. Investing activities relates to non-current assets on our classified balance sheet. Remember, we talk about investing as either long-term investments in securities, or the purchase of assets to use in our business, or the sale of those assets. And then financing activities in the statement of cash flows relate to issuing longer-term debt, or issuing stock, or the repayment of debt, or the repurchase of stock. And so those fall under the non-current liabilities and stockholders' equity section of the balance sheet, or at least relate to those sections on the balance sheet. So what we need to prepare a statement of cash flows, and where that information might come from, is we need the comparative balance sheets, because we look at balances from the end of last year, which is the same as the beginning of this year, and compare those to the end of the year. We need the income statement because we need to know what our starting net income was. In other words, that's where we start our operations section in the statement of cash flows. And we also need to know what our non-cash expenses that were included in that income statement were. And then we need other details from other accounts. For example, we're going to look at change in current assets and current liabilities and those types of things. So those are the kinds of information we need to prepare a statement of cash flows. So remember that the balance sheet equation is assets equal liabilities plus stockholders' equity. Also, think about what we're trying to do with the statement of cash flows. I mentioned earlier that what we're really doing is we're explaining the difference between ending cash balance last period and the ending cash balance this period. And so given that, we have to be able to figure out what our change in cash was. Pretty easy to do if we look at the financial statements, but let's recast that accounting equation just to help explain this. As assets, we can look at assets as cash plus everything else. So cash plus non-cash assets equals liabilities plus stockholders' equity. So how would we figure out what cash is if we had to, go through some cash solving type exercise? We could say, well, cash equals liabilities plus stockholders' equity minus non-cash assets. All we're doing is subtracting non-cash assets from both sides of that equation. And that allows us to figure out what our cash balance ought to be. So if we can do that, we ought to be able to figure out what our change in cash is just by looking at the change in those other accounts as well. Change in cash equals change in liabilities plus stockholders' equity minus non-cash assets. So if we look at all of those, if we derive those different equations, we can always figure out either what our cash balance should be or what our change in cash was, and that's the change that we're going to explain with the statement of cash flows. So learning objective 2 is to be able to construct a statement of cash flows, at least the operating activity section of that. Then of course we'll go through the investing section with learning objective 3 and the financing section with learning objective 4. Okay, I'm going to just put all of the elements of the slide in here so we can look at them all at the same time. Cash flows from operating activities using the indirect method starts with net income and then takes into account changes in current assets and current liabilities, any non-cash expenses that were included in that net income, and any losses and gains that were included in that net income to arrive at cash flows from operating activities. So let's start with changes in current assets and current liabilities. So we have net income. We add back, if we look at if our current assets increased from the beginning of the year to the end of the year, and these are the non-cash current assets. If any of those increased, we consider that a use of cash and subtract that difference from net income. If any of our current assets decreased, our non-cash current assets, we consider that generating cash, and we add those to net income. Let's use examples of those, and it's just the opposite for current liabilities. Let's say that from the beginning of the year to the ending of the year, our accounts receivable increased. What that increased means is that we made more sales on credit than, so here's a chart. So now let's take a look at an example. We'll use Under Armour again, and we'll try to prepare the statement of cash flows for the year end December 31, 2008, and we'll take a look at the financial statements and see if we can make that happen. So the first thing we'll do is we'll look at cash flow from operating activities. And remember, what the statement of cash flows is doing for us in its entirety is it's explaining this change in cash from the beginning of the year to the end of the year. So look at the cash and cash equivalents line here. Cash went from 40 to 102 million or billion dollars. And let's see, we're in millions here. So from 40 million to 102 million. And so we are going to explain that $62 million increase in cash flow for Under Armour, excuse me. And accounts, and think about this now in terms of current assets and current liabilities. Accounts receivable decreased by $13 million from the beginning of the year to the end of the year. And what did we say about a decrease in receivables? We said that means that we not only collected for all of our cash sales, but we also, and our credit sales, but we collected some additional from what must have been outstanding from last year, at least equivalent to that logic. So we are going to add that decrease in accounts receivable to our net income to arrive at cash flow from operating activities. Inventories, on the other hand, a current asset, increased from the beginning of the year to the ending of the year. So that must have used some cash to purchase that additional inventory. So we're going to subtract that from our net income to arrive at cash flow from operating activities. Prepaid expenses also increased, so that would have been an additional consumption of cash to increase those prepaids for the year. Now look at equipment. Equipment increased from the beginning of the year to the end of the year. And so we will show that in our investing activities as a use of cash. We see accumulated depreciation that went up from the beginning of the year to the end of the year. And what brings accumulated depreciation higher? Well, it would be the year's depreciation expense. Depreciation expense for the year must have been, if we didn't have other disposition of assets, must have been $16 million. So we will add that non-cash expense back to net income in the operating section. You see that happen. And then intangible or other assets also increased by $2 million. And so we will see that as a use of cash in the investing activities section. Now let's take a look at the liabilities and stockholders' equity section of the Under Armour balance sheet. So accounts payable increased from 55 to 72 for a net increase of 17 million over the year. And what that means is we were able to incur some expenses or increase, or buy inventory or whatever, or supplies, whatever the case is, without using cash. And so that's the same as, think about it in terms of, it's an expense that was accrued on the income statement as an expense, but we didn't spend cash to do that. So we'll be adding that difference back to net income to arrive at cash flow from operations. Accrued liabilities, the same thing. Net increase of $20 million, and so we will be adding those back to our net income, because once again, those were expenses that showed up on the income statement that did not use any cash. So we add that change back to income to arrive at cash flow from operating activities. Now we'll move down to the non-current liabilities. Long-term debt increased from 14 to 23 million for a net change of an increase of $9 million. So we must have borrowed additional cash in the form of $9 million. So we'll show that as a source of cash under the financing section of our statement of cash flows. Now we'll move down to the stockholders' equity section. You can see that contributed capital increased from 163 to 175. So we apparently issued additional stock and realized cash on that of an additional $12 million. That'll show up in our financing section as an increase in cash for $12 million. Retained earnings went from 118 to 156. If that's all net income, then that'll show up in our income statement. But we're going to want to take a look and see if any of that was dividends, and that will help us decide where to, how to account for those things in the statement of cash flows. So our starting point for the statement of cash flows when we're doing the operating activities section under the indirect method is going to be net income. And here we have net income of $38 million. And then remember, what we're going to do is we're going to look for non-cash expenses that were included in that net income. And we see depreciation of $16 million. Depreciation does not use any cash. And so we're going to end up adding that back. And then we're going to analyze the difference in our current assets and current liabilities and make those adjustments as well. So again, statement of cash flows when we starts with net income when we're doing the indirect method. So looking at the reporting of operating cash flows, we begin again with net income, and then we add back any non-cash expenses that appear in the income statement. Generally that's depreciation. If we have any amortization, we would add that back as well. Then we look at changes in operating assets and liabilities. Those are our current assets and current liabilities. We add back decreases in current assets. We subtract increases in current assets. We subtract decreases in current liabilities, and we add back increases in current liabilities. And that gives us net cash either provided or used by our operating activities. Whether we use the direct or indirect method for reporting our statement of cash flows, the cash generated or used from operating activities will be the same. So there's no difference in the result of the direct or indirect method. It's just in the way it's reported within the statement itself. So we're going to start with net income. We saw that net income for Under Armour for the year was $38 million. Next, we have to adjust for the non-cash items included in net income. And we saw in the income statement, the only non-cash item is for depreciation. So we're going to add that back. So we continue to build our statement. We start with net income of $38 million. We say adjustments to reconcile net income to net cash. First one is depreciation. We add back that $16 million in depreciation. We saw that depreciation in the income statement, and we also saw that $16 million be the result of the change in accumulated depreciation from the beginning of the year to the end of the year. So that shows us that that depreciation expense was the only activity in that accumulated depreciation account. Now, what we have to do is we have to finish this operating section activity, this operating section construction by analyzing each of the other current assets and current liabilities and including those on the statement as well. So we go through the same thing now, looking at each of the different current asset and current liability accounts, and you can superimpose in your mind or next to whatever this little chart that we looked at so you can get the idea. So we look at the change in accounts receivable. It decreased by $13 million, and so we're adding that back to net income. We look at the increase in inventory, so we're subtracting that from net income to arrive at cash flow from operations, and etc. We go through each of the current asset and current liability accounts to see whether they increased or decreased for the year, and then we include them in the operating cash flow section of the statement accordingly. Now we're going to move to the next section of the statement of cash flows, which is cash flows from investing activities. And recall that when we talk about investing activities, we're talking about whether we purchase or dispose of assets that we use in our business, or whether we purchase and dispose of securities. So in order to do this section, we need to know whether or not we had any dispositions of equipment or impairments as well, because remember, if a long-term asset becomes permanently impaired, we have to write it down, which includes an expense in our income statement. If that were to happen, that would not use any cash, so we'd have to add that impairment expense back in the finance or the investing activities section here, of course. And so anyway, we are told that we have no disposals or impairments of equipment or intangibles during the year, so we don't have to worry about those for this statement. But we did acquire $36 million of equipment, and intangibles of $2 million were also purchased with cash. So we need to know those two things, because those are both going to be uses of cash, and they're going to show up under the investing activities in our statement of cash flows. So this is a slide that shows those two things, and this would be the cash flows from investing activities section. Notice prior to that we had come up with net cash provided by operating activities of 79 million. Now we are looking at the investing activities section, and this shows that net cash used by investing activities was 38 million. That 38 million is attributable to the purchase of equipment of 36 million and the purchase of intangibles of 2 million. Okay, the third category we look at in the statement of cash flows is financing activities, and that's whether we either issue or repay debt, or issue or repay or reacquire stock in our company. In order to complete this section, we need to know a few other things. We need to know whether dividends were declared or paid, and we could usually find that information if we have the detail in the statement of retained earnings, but we're told here that no dividends were declared or paid for the year. We need to know whether there was any long-term debt repaid. We can do that by analyzing the long-term debt T account. If we had that information, here we're told that we repaid debt of $7 million. So that repayment is going to be a use of cash under the financing section. We're also told that 16 million in new long-term loans were issued, which means that we generated $16 million in cash by taking out long-term loans, and we were told that shares of stock were issued for $12 million. Again, we could get that information by analyzing our stockholders' equity account. We are given that here so that we can complete this section of the statement of cash flows. So again, first we were told that long-term debt increased due to 16 million in new loans being taken out, that where we got the 16 million cash in exchange for debt, and so we show that. Additional borrowings of long-term debt, $16 million, that increased our cash, so it shows up as a source of cash in our statement of cash flows. We were also told that we repaid $7 million of an existing long-term debt obligation. The net effect of these two transactions increased long-term debt by $9 million, from 14 million on the 2007 balance sheet to 23 million on the 2008 balance sheet. But you can see how that net effect involved two different situations. One is where we increased our borrowing, and the other is where we decreased our borrowing, and we are going to report both of those in our statement. And finally, we now know that the increase in our contributed capital account was due to the issuance of stock of $12 million, and so we are able to include that as well under that financing activities section when we say proceeds from stock issuance, $12 million. So now let's take a look at the statement and see that we have indeed explained the difference in cash from the beginning of the year to the end of the year. We determined that we provided or generated cash from operations of 79 million, that we used 38 million of cash in our investing activities through the purchase of equipment and other assets, and we have provided cash from our financing activities, net $21 million. 12 of that was issuing stock, 16 was from borrowing additional long-term debt, and we used 7 for payoff of other long-term debt. So we get the feel now for where our change in cash is coming from, and we can be somewhat comfortable that a lot of that change in cash is from our operations. We have positive cash flow from operations. That's always a good thing. We would expect that if we're growing, we're going to be using cash to reinvest in our company in assets. And we can look at, if we don't have enough cash, if we feel like we need to further leverage ourselves, we can either do that through debt financing or equity financing. And it looks like we made some of those decisions this year as well. So we're looking at, we look at what we started with for cash, we add our total change in cash for the year, and we come up with our ending cash balance at the end of the year. So we've been able to reconcile from our beginning cash balance to our ending cash balance through our statement of cash flows. Now, we're not quite done. There are a couple disclosures we have to make at the end of the statement of cash flows, and we'll do that in the next section. So when we're doing a statement of cash flows, we have to also disclose some supplemental information. And one of those things is whether or not we have what the cash amount was that we paid for taxes and for interest. And the indirect method, that doesn't show up on the face of the statement of cash flows, so we have to include those items. And you can see that we did that on the bottom of this statement now. Also, if there were significant non-cash investing or financing activities, we would have to include those at the bottom of the statement as well. For example, let's say we purchased equipment and issued a note in exchange for the purchase of equipment. Well, there wouldn't have been any cash involved in that transaction, but we still have to disclose that we had that significant transaction, and that needs to be disclosed at the bottom of the statement of cash flows. So let's take a look at learning objective 5, which is interpreting what we just created. And so we're going to look at cash flows from operating, investing, and financing activities. And even though we've talked about those as we've gone along, I will take one final look at those. As I mentioned earlier, operating cash flows must be positive over the long run. Our company's going to die. I mean, we're in business to generate cash flow from what we do, from our normal operations. And so we want to look at that. And if we see an upward trend in cash flows over time, that just means that we're operating more efficiently and probably growing, all signs of a healthy organization. A couple of ways that we would analyze our cash flows to see if we're being effective from a cash flow management perspective would be to look at quality of income ratio, which is a measure for determining what portion of the company's income was generated in cash. And if we have a 1.0, in other words, if our net cash flow from operating activities equals our net income, that indicates that we can kind of equate that to a cash business where we're collecting cash for our sales and paying cash for our expenses. Under Armour had a quality of income ratio higher than 2.08 to be exact. And what that tells us is that we are kind of managing our receivables, or collecting some of our receivables now that might have been a little, maybe even a little bit slower before, and perhaps even using a little bit of leverage on our payables. In other words, we are able to purchase on account and delay some of the cash payment for those items. And if our company is growing, it's a good thing to be able to do that, because we will generate the cash and the net income to be able to handle those short-term liabilities. The other way we will look at to evaluate our cash flows and the health of our cash flow is to look at a capital acquisitions ratio. And what this really tells us is whether we're generating enough cash to purchase our long-term assets, or conversely, whether we have to borrow to grow, and increasing leverage on a consistent basis could lead to trouble. So we want to see if whether we're generating enough cash to fund our growth. And what we do is we look at a ratio again of net cash flow from operating activities to the cash paid for property, plant, and equipment. A ratio greater than 1 indicates that we were able to generate enough cash to purchase our long-term assets. Our capital acquisitions ratio for this company was 2.19, indicating that we were able to generate enough cash internally to fund our acquisitions of property, plant, and equipment for the period. So the last thing we're going to take a look at in this chapter is how we report sales of property, plant, and equipment in the indirect method. Remember, if we dispose of one of our assets, and we get cash for that, that's going to show up as an increase in cash in our investing section. And I also mentioned early on, if there was a gain or loss associated with that disposition of an asset, that gain or loss would have shown up in the net income on the income statement. And so we have to adjust for that, because we want to show the gross proceeds of the disposition of that asset in the investing section. So this chart kind of explains how that works. If we had a loss on the sale of property, plant, and equipment, we add that back to net income, just like we would have for depreciation, because there was no cash used or consumed in that loss. We just got less for that asset than the book value. If there was a gain on sale of property, plant, and equipment, we're going to subtract that gain from net income because we're again showing the gross proceeds down in the investing section, and if we didn't back that gain out of net income, we would be double counting it or reporting it twice, once in the operating section and once in the investing section. So we remove it from the operating section so that we can show it in the investing section. And that's really all there is to this piece of the show. So now go ahead and look at some of the solved exercises and make sure that you understand the concepts that